Lesson 7. Assets. As defined earlier in this course, an asset is any item with economic value that can be converted to cash. Assets are resources that can be used to create income or reduce expenses and to store value. The following are examples of tangible, material assets: a car, savings account, wind-up toy collection, money market account, shares of stock, 40 acres of farmland, a home. When you use excess capital to purchase an asset in the capital markets, you are essentially storing wealth with the potential to generate income. This process involves converting your liquidity, cash or other easily accessible funds, into an investment. The liquidity of an asset refers to how easily it can be sold or converted back into cash. For instance, selling a car is generally faster than selling a house, making the car a more liquid asset. As an investor, you rely on the assumption that the asset can be sold when needed, provided it holds market value and trades in an efficient market. Market value reflects the asset's usefulness and desirability to others. However, if an asset lacks these qualities or cannot be easily traded, it becomes a possession rather than an investment. While possessions may offer personal satisfaction, they do not serve as reliable stores of wealth or sources of income. Understanding this distinction is critical to making sound financial decisions and ensuring that your assets align with your financial goals. Assets can serve multiple financial purposes. They can store wealth, generate income, and even help reduce future expenses. For example, if an asset appreciates in value and is later sold for more than its purchase price, the resulting profit is known as a capital gain. This means the investment has not only preserved your wealth, but has also grown it. However, the opposite can occur as well. If the asset loses value while you own it and is sold for less than its purchase price, this results in a capital loss. In such cases, the investment fails to maintain its original value and instead diminishes your wealth. Understanding the potential for both capital gains and losses is a critical aspect of financial planning and investment decision-making, as it helps you evaluate the risks and rewards associated with different assets. The ideal investment asset is one that not only retains but also increases in value, generating a capital gain while it is held. However, some assets go further by creating additional income while they store wealth. For instance, an investment in an apartment complex not only retains value, but also generates rental income. Similarly, owning a share of stock may provide dividend income, and deposits in savings accounts generate interest income. Investors often prioritize either asset value appreciation or income generation based on their goals. For example, some investors prefer stocks that reinvest profits into the company rather than paying dividends, as this can help the company grow and increase the stock's value over time. Such growth translates into capital gains, which can be advantageous because they are often taxed more favorably than regular income. For these reasons, investments that balance asset value appreciation with income generation are particularly appealing, as they offer both short-term benefits and long-term wealth-building potential. Conversely, some investors prioritize generating income from their investments over increasing wealth. Retirees, for example, often depend on investment income to cover living expenses after their employment income ceases. With a shorter time horizon and immediate financial needs, retirees may focus less on accumulating wealth and more on ensuring a steady income stream. This approach reflects a shift in financial priorities as individuals move through different stages of life, demonstrating how investment strategies must align with personal circumstances and goals. Some assets are acquired primarily to reduce living expenses, offering cost-saving advantages over alternative arrangements. For example, purchasing a car to commute to work may be more economical over time than renting a vehicle or relying on public transportation. While the car may not increase in value and thus does not serve as a store of wealth, its value lies in minimizing future expenses. In some cases, an asset can serve dual purposes, reducing expenses and potentially storing wealth. Buying a house to live in often exemplifies this duality. Over time, owning a home may be less costly than renting, and real estate can appreciate in value, allowing for a capital gain when sold. However, this appreciation depends on market conditions and housing demand at the time of sale, so it is not guaranteed. Despite this uncertainty, a house typically offers both financial and practical benefits by lowering living expenses and presenting an opportunity for wealth storage. The table below shows the roles of assets in reducing expenses, increasing income, and storing wealth. In conclusion, the selection of an investment asset ultimately hinges on its perceived potential to fulfill your financial goals, whether by storing and increasing wealth, generating income, or reducing expenses. An ideal investment balances these attributes, simultaneously enhancing your financial position and meeting your practical needs. If an asset fails to achieve these outcomes, it may not justify the liquidity used to acquire it. In such cases, the opportunity cost of the investment, the value of the next best alternative foregone, will outweigh the benefits it provides. Given the wide array of available assets, making strategic choices is crucial to ensuring that your investments are both productive and aligned with your financial objectives.